I'm Andy Panko, owner of Tenon Financial. Welcome to Retirement Planning Demystified. This video will explain qualified longevity annuity contracts, or QLACs. Be sure to watch to the end where I give some scenarios of when a QLAC could be something worth considering. But before we start, remember this video is only general explanations and education. It's not specific tax, legal, or investment advice. Before considering acting on anything you see in this video, first consult with your tax, legal, or investment advisor. Like all forms of annuities, a QLAC is purchased from an insurance company. It's specifically an income annuity, which means you hand over a lump sum of money to the insurance company in return for them agreeing to give you a stream of income payments for the rest of your life. And it's a deferred form of income annuity, meaning you choose some future date for when you'd like your payments to begin. This is in contrast to an immediate income annuity, where you would begin receiving your income payments soon after making your initial purchase. Annuities have been around for over 100 years, but QLACs in particular didn't come into existence until 2014. Prior to then, if you purchased a deferred income annuity inside one of your tax-deferred retirement accounts, like an IRA, you would have needed to start taking payments from the annuity no later than when you turned 70 and a half, which is when required minimum distributions, or RMDs, would have needed to begin. In some cases, people don't actually want or need the annuity income at such an early age. There are times when people buy a deferred annuity without wanting income to start until much later in life, such as in their 80s. Well, prior to QLACs, it wasn't possible to defer the income start date that long. But with QLACs, you can. Let's walk through some of the unique rules and provisions of QLACs. First, they can only be purchased inside tax-deferred retirement accounts like IRAs, 401ks, 403bs, and so forth. Unlike any other form of annuity, they cannot be purchased with after-tax money. Also, you can't buy a QLAC inside of an inherited IRA, even though that is a tax-deferred account. Next, there's a maximum amount on how much QLAC you can purchase. Specifically, you cannot spend more than $135,000 or 25% of your tax-deferred account balance, whichever is less, on buying QLACs. The $135,000 limit is a lifetime limit. For example, you can buy a little bit of QLAC each year if you wanted to, so long as your aggregate purchases do not exceed $135,000. And the 25% limit applies to each different account type. As an example, if your 401k has $200,000 in it, the most you can use to buy a QLAC inside it is $50,000, which is 25% of that account balance. IRAs are a little different. If you have multiple IRAs, again excluding inherited IRAs, you can aggregate their balances together for purposes of applying the 25% limit. Third, QLACs have limited payout options. Specifically, you can only select a single life payout, or if you're married, you can instead choose a joint life payout. A single life payout means income payments will last until you die, at which point they stop. A joint life payout means income payments will last until both you and your spouse die. And whether you choose the single or joint life payout, you have the option to add what's called a cash refund provision. That means if you die before receiving an aggregate amount of payments large enough to cover the total amount of initial purchases you made, upon your death, your beneficiaries will receive a payout for the difference. For example, assume you paid a total of $100,000 to buy a QLAC. If you die and only receive payments totaling $80,000 up until that point, your beneficiaries will be paid out $20,000 by the insurance company. On the other hand, if you had already received at least $100,000 of income payments before you die, your beneficiaries would not receive anything from the annuity upon your death. QLACs allow one additional feature that can be added to your payout. You can also add an inflation rider, which is a mechanism that will increase your payments over time as inflation occurs. Finally, you can't delay the start of your income payments later than age 85. Specifically, you have to start your payments no later than the first of the month after the month of your birth. And that brings me to one of the other interesting aspects of QLACs. They delay required minimum distributions. As I mentioned earlier, before the inception of QLACs in 2014, annuities purchased within a tax-deferred account needed to start paying out when the annuity owner reached RMD age, which was 70 and a half. Now, when you purchase a QLAC, the amount of your QLAC purchase is excluded from RMDs. Let's look at an example. Assume you have $500,000 in your IRA and you're age 72. The IRS says you need to withdraw at least 3.9% of your account balance in the year you're 72. In this case, that's about $19,500 of taxable income you'd need to take out of your IRA, even if you didn't need or want the money at the time. On the other hand, if you instead use $100,000 to purchase a QLAC in that IRA, you'd only have $400,000 that will be subject to RMDs because RMDs are not required on the amount of the QLAC. Again, assuming you're 72, you'd need to take out and pay tax on 3.9% of your account balance of $400,000. That means your RMD would instead be only $15,600. For more information about RMDs, check out my other video, Understanding Required Minimum Distributions. While it may seem nice to have smaller RMDs and therefore smaller current tax bills, you need to keep in mind QLACs don't get rid of RMDs, they basically just kick them down the road. When you do eventually start receiving payments under your QLAC, 100% of the payments will be taxable at the time. And those payments you'll get will be on top of whatever RMDs you have to take on the rest of your tax-deferred account balances. So QLAC shouldn't be used just because you want to try to minimize current RMDs and taxes thereon. So when should you consider buying a QLAC? There are a few reasons to consider buying one, but the main reasons are a combination of you think you may live a long time, meaning you expect to have longevity, and you're concerned about potentially running out of money if you do live long. Recall the L in QLAC stands for longevity. By design, a QLAC was created to help people provide themselves some financial protection against longevity. In other words, it's a form of longevity insurance. So, if you think you may live a long time and/or are concerned about outliving your money, maybe a QLAC is something to consider. Another reason to consider a QLAC is if you have a low tolerance for financial risk. If you lose sleep over seeing your retirement accounts fluctuate in value as the stock and bond markets move around, then maybe the safety and security of a QLAC would be of benefit to you. This holds true for most forms of annuities. They typically provide more stability and certainty than traditional investment products. Another consideration is your legacy goals, meaning how much money, if any, you want to leave to your heirs after you're gone. If you're okay leaving less to your heirs, purchasing a QLAC could make sense. This is because QLACs don't provide a death benefit unless you choose to purchase a cash refund option. But even then, there is a chance there may not be much, if any, cash refund left, particularly if you live a long time. Before wrapping up, I want to briefly mention how the income payment amounts are determined in QLACs. Like all forms of annuities, the amount of income you'll receive is a function of a few things. First, the more money you put in, the larger your payment will be. This one is pretty self-explanatory. Second, the higher the level of current interest rates, the higher your payment will be. This is because the payment amount the insurance company agrees to give you is based on their expectation of how much investment return they think they'll be able to get on your money. All else equal, the higher the interest rates, the higher the insurance company's assumed investment return, and therefore the higher your payment. Next, the later your payment start date, the higher your payment. As you age, your remaining life expectancy decreases. That means there will statistically be less payments the insurance company will have to pay you. So by starting payments later, your payments will be larger. But the downside is obviously that you run the risk of living long enough to get enough payments to at least break even on your original purchase. Now, this may or may not be of concern to you, because frankly, after you're dead, you're not going to care. But if you have goals of leaving a lot to your heirs, then you need to think carefully about this. Also, all else equal, payments are likely to be higher for men than for women. This is again due to life expectancies. On average, men die sooner than women, which means insurance companies expect to make less payments to men than to women. Finally, the less options and features you tack onto your QLAC, the higher your payment will be. As an example, if you select a single life payout, that means payments should end sooner than if you select a joint life payout, which means payments for a single life will be larger than payments for a joint life. And one last comment. Where do you go to actually buy a QLAC? As of the creation of this video, there are only 8 insurers that sell QLACs. Thankfully, they're all large, well-known firms with strong credit ratings. You can do a simple Google search like which insurers sell QLACs to find ones that do. Well, that's it for QLACs. I hope you found this video helpful. If you haven't already, subscribe to this channel so you can be the first to know when new videos are posted. And don't forget to subscribe to my monthly newsletter, Retirement Planning Insights, which provides informative retirement planning tips and info. Also, be sure to join my free Facebook group, Taxes in Retirement, where you can get answers to all your retirement-related tax questions. Thanks for watching. I'll see you soon.